Okay, let's look over to the left under the blue bar that says 2021. So most all of us in the past decade, 10, 12 years that are accredited investors, investing in commercial real estate, you were an LP for the most part, all right? And if you look there, you have common equity. Well, the sponsor could come in and say, okay, I'm going to get a construction loan or an acquisition loan of 75%, maybe 70, but let's just say 75 for sake of discussion here. Pretty close. And that was what we saw for, from 2012 to 2022, maybe 2010. That was fairly standard. Well, because of this, perfect tsunami of numbers, interest rates up, valuations down, leverage down, some banks are overexposed. You've seen that capital stack shift. Well, now that senior debt has gone down to closer to 60%. So what is that sponsor going to do to fill that gap? Well, he can raise a little more common equity, all right, do a capital call, put a little more money in, and or they can come to people like us and say, hey, we need this gap for you can you fill it for a period of time, say 2, maybe 3 years, short term, and we will put you above the common equity. So what happens here is that you have distribution rights above the common equity. So the senior debt obviously first, then we would come in with the preferred equity and we would receive our payment before the common equity would receive theirs. Now, what's interesting is we've received multiple offers over the last year and a half to fund deals. And when we underwrite them or when they're presented to us, they're literally presented in, that the IRR or the return is going to be somewhere in that 10 to 14%. And that's the common equity. Now, remember, it's behind the preferred equity. And I kind of think to myself, I go, can I literally take this to my common equity investors and say, you know what? I can pay you a projected 10 to 14% on a project, or I can give you a preferred equity, which is contracted. Now, we don't get the upside, but we get paid first. I'll give you a preferred equity at 12%. And it's just not even worth it. Okay. You're going to take the preferred equity. And if you think about it, the common equity at 10% or the preferred equity at 12, you're getting a 20% greater return, potential on that than you would. So why would you do common equity? By and large, I don't see any reason to take that additional risk, when you have a more or less of a contracted payment that sits above the common equity. So that's a picture of what it looks like. So that's where we are today.